Welcome. My name is Kim Schneider, and I am the president of the Gotham Gator Club based in New York City. We are very excited to co-host this webinar today. We are joining, this is a Resources Alumni webinar series, and today's topic is fiduciary financial planning. I am happy to introduce you to today's speaker, James D. Virgilio, fiduciary financial planner and investor, a 40 Gators Under 40 honoree, and a featured guest on leading news networks. James.
Thanks for having me. It's great to be here, and hello from Florida, and obviously hello to New York, and hello all around the country and possibly the world. Thanks for joining me today on this. What we're going to do is we're going to walk through about 20 to 25 minutes of material, which is going to cover what I think are the most important foundational concepts when it comes to managing your wealth, whether you're in the initial stages to begin to grow your wealth or you're further down the path and you're figuring out how to plan for retirement. Whatever the case may be, we'll cover what needs to be covered as efficiently as possible, and we'll leave ample time for questions after the talk, so you can ask any kind of financial question that you want, and we will discuss it. We've already got a bunch of great questions already, which is fantastic. So with that, I'll go ahead and share my screen, and then we should be able to get this going. Question that you want, and we will discuss it. We've already got a bunch of great questions already, which is fantastic. So with that, I'll go ahead and share my screen, and then we should be able to get this going. All right, I think everyone can see this, yes? We've already got a bunch of great. Hopefully, yes. I'm hoping everyone can see that. I don't know.
We can see it.
Perfect. Okay, so I've entitled this Financial Wisdom because I think it is actually wisdom to make sure you manage your money correctly. The good news is there's all sorts of opinions that exist in the financial world, and there actually are some very good black and white answers. So there's a lot of myths that we need to clear up and get past, but there are a lot of good concrete answers that you can use to benefit your financial situation. As you heard already, I am an adjunct professor at the University of Florida. I also am a certified investment management analyst and a certified financial planner. But most importantly, I'm a fiduciary. If you don't know what that is, that means that I always have to act in the best interest of you. So any question that I answer today is through the lens of what's best for you. Anything I do in life as a financial advisor and a wealth manager is to do what is best for the person that I am giving advice to. So that's a really important legal duty and oath, and it should help guide us as we seek to answer these questions. With that in the rearview mirror, let's start talking about budgeting. So any financial plan needs to start with a budget. Many people overcomplicate this because really there's one extremely important facet, and all the rest are highly flexible and dependent upon what you want to do. The first and by far most important thing is investing for retirement. You need to save and invest at least 10% of your gross income. Gross income is before taxes, not your net income, but your gross income. And depending on your age, you might want to ratchet this up. If you haven't saved anything and you're in your 40s, you might want to do 15, 20%. If you're in your 50s, 30, 40, as much as 50% of your income in a really bad situation. But for most people, you want to give at least 10% of your gross income. That's not a magic number. Mathematically, if you're investing that over time, that's going to allow you to retire and then replicate the same standard of living you had while you were working. All the rest of the options you see there, those are your rule of thumb. So 30% for housing expenses, so on and so forth. But those are highly flexible. It doesn't actually matter what you spend the rest of your money on. A good budget over time is going to have a surplus. So you're not going to wind up spending more than you make, and you're going to wind up always putting 10% away for your retirement. That's it. Everything else, again, totally negotiable, really does not matter nearly as much. We're going to talk about debt here in a second, but that's all highly preferential. So again, save more than you spend, right? Every single year, that's the goal. Don't outspend your budget. And then from there, make sure 10% goes to your gross income, from your gross income to retirement. Here's a very simple example. Imagine you made 40,000. There's your taxes. Now, depending on where you live, they could be higher than that, right? But just an example, you have a net income and a monthly income, and you kind of get an idea of what that looks like. The only reason I even illustrate this is to display that when we are investing for retirement, it comes off the gross. So if you make 40,000, you should be saving at least $4,000. You make 100,000, you should be saving at least $10,000. If your company gives you a match and you get 3, 4, 5%, whatever the case may be, That's fantastic. You could wind up reducing what you are giving. So you could wind up giving 6% plus your company's match of 4% to get to that 10%. But I think it's beneficial on your own to always give 10%. That way, if you change jobs, you're in a habit, you're in a routine of always investing 10% of your income, no matter what your company matches. And the rest of that match is just going to accelerate how much wealth you build. All right, so when should you start investing for retirement? Of course, everyone has heard the answer is now, and that's true. The reason for that answer is compounding. If we imagine that half the people on this call, we're going to wind up starting to invest now, and the other half we're going to start later, they're going to invest in the same exact investment. So they're going to wind up getting the same exact return over the life of their investment. Although the first group that starts investing now is really only going to wind up saving a little bit more, just $18,000 more in this example, by the time they retire, they're going to wind up having $250,000 more in wealth. So again, save a little bit now. That's going to compound. Compounding interest, Albert Einstein called the greatest force in the universe. It is in fact that powerful, right? It's a snowball effect of if you make 5% a year every single year, that's going to exponentially grow over time. So of course, it's going to wind up becoming much larger. So when is now? It's a good question to ask. Now is when you're making an income. As soon as you start to make a steady and stable income, now is the right time to begin investing for your retirement. 10% should go from your gross. Again, we'll talk about how to manage debt along with that in a minute. At the same point in time, you also want to build an emergency reserve account. So typically you're going to wind up having 3 to 6 months of income set aside to build your emergency reserves. This is going to prevent you from having to liquidate any investments if things go sideways in your life. Life is very unexpected for all of us. So it's really, really important to set something aside. If your job is very stable, you're a doctor, if you're a nurse, if you're a pharmacist, you can wind up saving less because it's far less likely that you'd be unemployed. If your job is more risky, if you're with a startup, if you're a salesperson, if you're in a highly cyclical industry, you want to look more to 6 months. And you do want to keep this in a very liquid investment, something like cash. If I were going to give a much more nuanced version of this, we could talk about what you do if you build a lot of wealth. At some point in time, you would not keep your emergency fund account in cash. But for most people, you're going to want to build a cash reserve. You leave that very liquid, put it in a money market or something you can access immediately. It's not going to fluctuate. And if something does go wrong, you're able to provide yourself with 2 to 3 to 4 months of living expenses. So you don't have to just take the next job that comes along, but you are able to plan and you're able to be methodical and you're able to do what's best for you and your family. Typically, you want to build your reserve account to full capacity over the course of 2 or 3 years. It's not something that needs to be done immediately. So you could set aside a couple $100 a month for 3, 4 years, and eventually you'll have a full emergency reserve account. When it comes to debt, this is a big one. We could spend a lot of time talking about student loan debt and credit card debt and a bunch of other things. But really, what I want you to take away from this is no matter what kind of debt you have, first and foremost, you do not want to extend the term. So with student loan debt, the most typical time to repay your debt back is within 10 years. A lot of people will push that term out further. And the reason they will do that is because they want to save money. They want to save money. You can see right here that although we're going to save our monthly payment quite significantly, we get $143 back in our monthly budget, it's going to wind up costing us a lot by the time we pay off this debt. So what is the lesson here? You never want to look at debt on a monthly basis. You always want to look at debt on the total cost basis. Over the course of this loan, how much is this going to cost me? And you want to make your decisions from there. So that would tell you that if you're borrowing money, you do not, in general, want to extend these terms way out into the future, especially at a high interest rate like you see here at 6.8. Most student loan debt's at 5 or above. So for all of those debts, you definitely would not want to extend. When it comes to credit cards, it's much worse. Most credit cards are above 15%. Of course, not all of them, in interest. And if you're trying to get out of the credit card debt hole, a lot of people will want to wind up taking a big chunk right away, kind of try to pay it off right away. They feel stressed out by this. They'll make a big payment, then a year will go by before they make another payment. A really simple strategy is simply to take your monthly payment and then just double that. Just double the monthly payment that you have to make, and you're going to wind up getting out of debt much, much faster. And it's stable, it's simple, it should not affect your budget too much. Again, take home here is the higher your interest rate is, the faster that compounding, which we talked about, compounding is going to work against you, right? So compounding either works for you or it works against you. You don't want it working against you, and that's what happens when you borrow money. The higher the interest rate, the worse this is. When we're talking about debt, anything that's below 4% is considered to be good debt. Good debt. So that debt you could carry for indefinitely or for a long time. Between 4 and 6, it's getting pretty high. You want to pay that off. Anything above 6, you want to pay off as quickly as possible, as that compounding is going to really, really work against you. So when it comes to your credit cards, pay off twice the minimum. When it comes to your student loan debt, again, you want to pay that off in 10 years or less. And when it comes to borrowing money to go to school, if you're thinking of going back to grad school or you're paying for whatever degree you're looking at, the rule of thumb is borrow the same amount of money or less than what you plan to make coming out of school. Borrow the same amount of money or less as what you plan to make coming out of school. Really, really crucial to make sure you do that. Oftentimes people will go get a history PhD. They come out of school, they're going to make 70, 80 grand, but they have $150,000 of debt. Not a good situation. So make sure you match those two things up. All right, there's your little remember card. Pay your highest interest rate debt first. Don't extend your debt. Don't push it out for a long time. Now, of course, if you have a 0% interest rate, push it out as long as you want. If you have a low interest rate, you can push this out much further. But anything above 4, don't extend it. Always trust the math. Really simple rule here, but anytime you're looking at debt financing, it's just math. You want to choose the best deal for yourself. This will come into play with home refinancing as well as anything else. Look at the total cost of the loan, total time it's going to take, and just look at the math. If you wind up paying less doing that, that's the right path to take. If you wind up paying more doing that, again, with a high interest rate, not a good plan. And in general, when it comes to borrowing things, you want to get to a point in your life where you don't have to borrow money to buy things that won't make you money. So, for example, a car. Borrowing money to buy a car, generally not a good idea, especially if you get an interest rate above 4%, because cars are going to lose you money. So you're compounding the negative effect on your wealth. All right, let's take a look at should you buy or rent a house. This is one of my favorite topics to talk about. We don't have time to do it full justice today, but 82% of Americans think that the house they live in, not a house they're going to buy and rent out, but the house they live in is the best investment they can make. So the question we have to ask ourselves is very simple. Is owning a home actually a good investment? You're going to see historical data here going back to 1890. We take a look at a home that was worth $100,000 in 1890. We equate it all the way throughout time to get the same index value. And what you see right away is we sort of have two histories for home values. We have really up until 1990, where things for the most part were pretty consistent, minus the Great Depression. And then we have everything after 1990, where you sort of have the bubble housing market, the drawdown, and then really the rebubbling, if you will. When we take into account all the history you see, homes actually only appreciate at 0.4% a year when adjusted for inflation. That does not seem like a great investment. So if we're looking at the nominal return, and a nominal return is what your return is minus any of your costs. There's no cost here. There's no taxes. There's no maintenance here. It's just what you make by owning a home. Things don't look so bad. You can see during the good years, we're making a pretty decent rate. And during the bust years, we actually still made a return. So maybe owning a home is not so bad after all. But if we look at the real returns where we factor in all of the costs, so what's your mortgage cost, what's your maintenance cost, what are your property taxes, what's your insurance level, so on and so forth, it's a very different picture that we see. In fact, the real returns on housing are very bleak. This is why if you were to talk to a real estate professor at Stanford or Harvard or Yale or pick any school you really like, you're going to get the same answer. Owning a residential home and living in it is not an investment. In fact, it's not a good investment at all. On average, you're losing quite a bit of money. People are notorious for not factoring in all their costs. They're also pretty notorious for saying, well, my friend owned this home and they sold it for this much, or I own this home and I sold it for this much. Of course, sometimes you can make a nice return by owning a home, but in general, on average, you can see that owning a home pales significantly in comparison to owning an investment like an index fund in the S&P 500. So we have to be careful when it comes to owning homes. I've done a large study on buying versus renting homes. You can see how complicated it is. This is one of the real reasons why people struggle to evaluate how much they spend on their homes. What I want you to note is not all the little subtitles here. You can read that on another day on the website. You can see the full study. But here you see the take home. So if we're looking at should I buy or should I rent, and we're just looking at maximizing our wealth, the renter actually loses less money than the buyer. Now, this is not true in every single market. across the country. Again, we're talking about averages here. But on general, in average, if you rent a home, you actually wind up losing less money. Now, note both strategies, you are losing money on average than you would by owning a home. Now, I know a lot of you right now are probably pretty surprised by this. It's opposite advice to what you've heard or seen. I can assure you mathematically this holds up and this is very, very true. And it should tell you that if you're renting and you're also investing 10% of your gross income, that you in fact are on the right path and you are not lighting money on fire. There are reasons to own a home. If you're going to do it, keep this in view. On average, the home that you buy is not going to be a good investment. In fact, it is going to lose you money on average. Because of that, if we're strictly talking about building wealth for the future, the smaller home you buy or the less money you put into a home, the more money you would be able to employ in investments that would actually make you a return. Therefore, that would make you more wealthy. With all that being said, again, there are lots of good reasons to own a home. Just don't make it an investment or don't assume you're going to make a ton of money off of it. You can see the rules of thumb here, 2.5 times your gross income. That's very, very low. If you go to a mortgage bank and you say, I want to buy a house and I'm making 120 grand a year, they'd be happy to lend you much, much more money. But your job is not to listen to the mortgage bank. Your job is to do what's sound. That's 2.5 to 3 times your gross income. Always put 20% down. Always put 20% down, even with a very low interest rate, because you do not want to pay PMI. You do not want to pay PMI. It is an added cost. It does not reduce your payment or interest value. It significantly increases the cost of your loan. Always put 20% down. In very low interest rate environments like today, just put 20% down. No need to go more because you can borrow money very, very cheaply. But again, put 20% down. And always choose a fixed loan. Do not choose a variable loan. It's one of the big problems that cost people a lot of money during the '08 market crash. Choose a fixed loan. Anytime you have debt, you want to know exactly what you have to pay over the future so you can plan accordingly for it. All right, insurance, very quickly, just highlights here. Disability insurance is the most likely insurance any of us will ever need. Make sure that you have it. Almost everyone can get this through their employer. If you can't, make sure you get it. Life insurance, the only kind of life insurance you almost certainly ever need is term life insurance. You want 10 to 15 times your annual income. There is no need to get whole life insurance or permanent life insurance in almost all situations. Most of the things we're talking about today are on my firm's website, cddwealth.com, and you can get all of these. They're sort of white paper articles on the math behind this, but for now, term life insurance only. Auto insurance is very important. It's your first line of defense against being sued. Make sure you carry enough to cover the assets that you have. As you increase your assets and your income, increase your auto insurance. And lastly, when it comes to annuities, and we'll talk, I'm sure, more about this in the Q&A, my rule of thumb basically is never get one. There's almost never a reason to get one, whether they're fixed or variable or a whole host of other things. Do not mix insurance with investments. Insurance companies charge you far too much for what tends to be mythical protection over your investments. Again, a topic for another day for sure. But as a take-home rule of thumb, there is really no reason to get an annuity. All right, taxable versus non-taxable accounts. We're going to spend almost no time on this. We should spend more. Taxable accounts are accounts that you get taxed on every single year, depending on the investments that you own. And a non-taxable account are traditionally called retirement accounts, your 401k, your 403b, if you work for the government, your TSP plan. Those are your retirement accounts. You put money in, you get a tax break, and then the investments that you're making are not being taxed until you take the money out when you retire, unless you choose the Roth, in which case you get taxed the year you put a contribution in, and then you wind up never getting taxed again. The common wisdom is that Roth accounts are better for most people. Taxes are very low. We could assume that the Roth would be the wise choice given those circumstances. When we look at the math, we find something that is quite surprising. I often will go through why this works and how this works, but for today, I'm going to give you the conclusion and the take home. For most of you watching this, the right thing for you to do is to choose the traditional 401k or 403b or an IRA when possible instead of the Roth. And you can see your mathematical rubric right there. If you're single and you make more than $40,000 of an adjusted gross income, so that typically means you might make 55 or 60, as a regular gross income. Or if you're married and you make more than $80,000 of adjusted gross income, then you actually should choose the traditional 401k instead of the Roth, despite the fact that you will often hear the opposite. Again, long articles on the website that will discuss this in full, but that is in fact what the math says. That's what you should be doing. There are lots of reasons for this, no matter what happens with taxes in the future. And you can see that it laid out. Here is a simple example today to show you that this does in fact make a huge difference. I'm not going to walk through this, but imagine you make 100K a year, you go through your whole life saving in either the 401k or the Roth. By the time that you retire, and then let's say you live to be your 90s, you're talking about a $600,000 difference in the example we gave here. And of course, this will vary based upon your income, but there is in fact a very real difference depending on which account you choose. And if you follow that rule of thumb I've given you there, you should be in great shape. Okay, lastly, for today's talk, before we get into Q&A, we'll talk very briefly about investing. Again, investing is a very complicated subject. There's many, many things we could talk about. We're going to talk about the biggest and most important ones. First and foremost, what should you invest in if you're trying to make money over a long period of time? Here's 200 years. And the answer is very obviously stocks. It's something I'm sure all of you know. Of course, stocks look great. After inflation, you're making 6.6% a year. And it looks like a smooth ride. The Great Depression on this chart doesn't even look like a big deal. It looks just nice and simple and easy. If we step down to things like bonds or bills, which are just shorter term bonds, gold, which by the way is not a good investment, the dollar, which is losing value due to inflation, right? Your dollar becomes worth less every single year. And then you see real estate, which again, I'm not making that up, right? Real estate's extremely woeful. If we chart it compared to other investment types, it's just not a very good one. So with all this in the rearview mirror, we would expect that most people would want to be investing in stocks, regardless of age. Stocks are what's going to generate your income. We should all have some portion of our investments in stocks. But what we find is that people actually tend to put most of their money in cash, whether you're 20, 30, 50, 75, 90, you probably have a lot of money in cash. In fact, if we look over the course of your lifetime of what your holdings were, the majority of the time you would be holding cash, despite this being one of the worst actual strategies you could have. Then you can see in second place equities, which is actually the best thing to have. Why am I telling you this? Why am I showing you this? Because the number one most important thing when it comes to investing is to have an investment strategy. There are several ones that work. No matter what the climate is, whether it's an election year or not, you need to have an investment strategy. If not, you will wind up looking just like this. And the average investor does not fare well. The average investor gets just 1/3 the return of the S&P 500. The S&P 500 represents 98% of the US stock market. Most people will hold some sort of investment that follows the S&P 500, but despite that, they're only going to get 1/3 of the return. They're going to do even worse in the bond market. This has a whole lot of reasons to do with our own human behavior, how we chase returns, how we get afraid during times that seem scary because they are. We just tend to move in and out of investments at the wrong time as individuals, and it costs us dearly. One of the major reasons this happens is hurting. There's a lot of behavioral components we could talk about today. I tend to like to talk about this one because it is the most powerful, but humans coded within us prefer to follow the crowd. We prefer to follow other people. Simple example here. On the left side, we have a standard vertical line. On the right side, we have 3 lines. In an experiment that started in the 1970s, if we put 15 of you in a classroom and send one person out, and I tell the rest of the class, I want you to emphatically answer the question, which line on the right is the same height as the line on the left, with B. Raise your hand, it's B, confidently say B. And we're going to see what happens to the one student that doesn't know we're doing this. Well, 7 times out of 10, when you run that experiment, that other student's going to also raise their hand and say B. Regardless of age, education level, income level, it's just kind of coded within us. And the reason we do that is we will readily deny logic to conform with others. Even if we know the correct answer is not B, we don't want to be the only ones raising our hand. That's uncomfortable. We don't like that. We'll just slide on in with them. Or we actually doubt ourselves and say, well, maybe they know something that I don't know because they're all raising their hand confidently. And maybe I'm just not seeing this correctly. So I will agree with them as well. This happens in investing. We'd rather be wrong with everyone than sort of right by ourselves. It's very, very hard. It's very, very hard to follow a path that's right when no one else is following it with you. And then coming right down to the end here, we're going to compare just very quickly several different investment strategies. We've already talked about the average investor and what they're going to make. We can take a look at the return, how much that return moves around per year, called volatility, the fluctuation. And then we can plot out kind of what we'd expect to make on average using a variety of investment strategies. The first two strategies are not ones you'd ever want to use. One, you don't want to be the average investor without a strategy. And two, you don't want to be buying and holding just a couple of stocks. That's not a good strategy either. On average, you're not going to do very well. Once we get down past those two, really all the rest of these four strategies you see could in fact work, and they could work pretty well. You can buy and hold an index fund like the S&P 500. You can buy and hold stocks and bonds using index funds or mutual funds and hold on to those. Or you can buy and hold multiple asset classes like commercial real estate, foreign investments, etc. Or lastly, you could use something called dual momentum, which focuses on human behavior. We won't have time talking about that today, but the reason I'm showing you this is to kind of give you an idea of what a professional investor looks at. The blue box is the range of expected values we could have. So although you're seeing the average listed there dollar-wise, the blue box is showing you how much it could fluctuate. And nobody has any idea in the future whether we're going to be on the low side of those blue boxes or the high side. But as you choose the better investment strategies, you can see that even your worst case scenario winds up still being a good one. And that is the key. So you really have to have an investment strategy. That is, again, by far the most important thing to do, as the majority of them will get you where you need to go, as evidenced here by the modern day performance of the four we're talking about. Again, the S&P 500 is just going to buy and hold an index fund your entire life. Stocks and bonds with a 60-40. That's most commonly what you see in your retirement account. If you see a target date fund, a retirement life cycle fund, those are based upon that. Multiple asset class portfolio, which, as we mentioned, holds more than just stocks and bonds, or this concept of momentum. And again, we don't have time today to cover these specifically. I just want to illustrate, as you can see on that worst case drawdown line there, how significant the strategy you choose is, how much more impactful it can be on your future wealth building. And again, regardless of which one of those you choose, you would need to stick with your plan. Don't deviate off your plan, despite the fact that all of them are going to have challenging years and challenging periods. You have to have a good investment strategy, and then you have to stick with it. Okay, lastly, whether it's financial planning or investing, we have to overcome ourselves. Emotion causes us to abandon our strategies. This is true not only in finance, but it's also true in life, in favor of chasing things that seem good today. Well, I'm not sure that I've been doing this my whole life. It seems to work, but now this other thing is working for someone else. Maybe I'll abandon this. That is almost never the right plan. And then we need to combat our own emotion with knowledge, right? Knowledge is what allows us to combat our own fears, our own failures, know that what we have is right and true, and then trust it and stick with it, regardless of all the noise and the things that are happening around outside of us. Last but not least, if you are going to select someone to help you, which I would highly advise and recommend, no matter what stage of wealth building you're at, choose a fiduciary. A fiduciary has to act in your best interest at all times in every engagement. Really crucial to do this. Unfortunately, only 15% of financial advisors, wealth managers, whatever name you want to choose to call us, are fiduciaries. Very few financial planners, despite anybody being able to call themselves a financial planner, actually have a certification that is really worth anything. You want to select a certified financial planner. 1 in 5 financial planners have that. So make sure you get a fiduciary, make sure they're a certified financial planner. And then when it comes to investing, things are even worse. Investing is sort of like the Wild West. At times it feels like gambling. Educationally, this is reflected by investment advisors. Only 4% of them have a certified education in actual portfolio management. So you want to look for someone that has either the CFA or the CIMA, as both of those are portfolio management credentials and designations. Everyone else, not that they're winging it, but again, they don't have what I would consider to be an education you'd want to have if you're hiring someone to work for you. So it's really important when selecting an advisor, I think, to be very, very rigorous with this rubric. Stick with it no matter what city you're in. You would have a firm or some people that would fit this credential, this skill set. So look for those. And with that, we'll open it up to any questions that you have. And on this call, joining me today is Sarah Ganum. She's a 2012 Pulitzer Prize winner and CNN correspondent. She's way overqualified to be helping me with the Q&A section. But any questions that you do have, set them in the chat box. You can also, I think, enter in possibly and unmute your mic. I'm not sure about that. But at this point in time, we'll take anything that you have. And I know we already have some questions sent in as well that I'll answer.
Yeah, so I'll jump in here. Great presentation. Thank you. I think actually from the submitted questions, James, you tailored a lot of your presentation to what people have asked. So that's wonderful. I think I'll keep an eye on the chat. I think that's the easiest way to ask questions. So if you do have something to ask James directly, why don't you stick it in the chat now? I know that we already do have a question about whether or not you can share your slides. So take a minute and think about that. And I'm going to just ask from the submitted questions pre-presentation, the first question, which was, what would your advice be for someone who wants to get involved in investing in the stock market, but does not know where to start?
Right, and that's a big question. You look at it like learning a language. You're not going to learn how to speak French, in a couple of weeks if you've never spoken French before. Except if you're learning to speak French, the costs are not very high. If you're talking about investing, the costs are very high. If it's something that interests you and you really want to learn about it and do it on your own, you'll need to do a lot of reading. There's plenty of good resources and places to begin for that. Websites like the Motley Fool or Investopedia can help you to get going. But in reality, I think it's really wise for people to outsource. We have very limited time as humans. It's very, very wise for you to outsource financial management to someone who does it professionally, especially if you select the right person. There's no easy path to becoming a wise investor. There are no shortcuts. There is no simple little rubric to get with. So again, I would be very careful would be my answer to that, as it's going to take quite some time to truly feel comfortable becoming a do-it-yourself investor.
So the first question we have from an audience member is from an anonymous. It's an anonymous question. Hi, James. As someone who is currently paying into my state's retirement system as an educator, what other options should I consider as investments in order to be prepared for retirement at the end of my career?
So if you're looking at, you're a teacher, let's say you're in the state of Florida, for example, and you're going to be able to choose either the Florida retirement system or you're going to be in a TSP plan. That's like your base retirement, right? That's your base option. You can save a lot of money in there. The first goal really is to max that out. And the reason for that is the tax deferral benefit that you get is going to be excellent. Even though your choices are very limited, you can actually employ any one of the four strategies that we showed today and talked way too briefly about in an account like that. So even though your choices are limited, you can manage that account reasonably well. And then if you begin to save even more to where you're maxing out that account, you can use other accounts to supplement that. But for most people, you actually would never need to supplement your 401k or 403b or TSP with anything else until your income starts just to reach above, 150 or $200,000 a year. You'd be just fine maxing out that particular account. So I would say max that account out, as well as make sure that you have an investment strategy you are using beyond just letting it sit in that account. Make sure you know what you're investing in. And then Sarah, I will share all these slides, so all of you will be able to see them. You can have them, you can use them. So don't worry if you miss something, they will all get sent out to you.
Great. Thank you so much. I know all of us, myself included, learned a lot from them and would love to spend some more time with them. So that's really appreciated. The second question is, how do you suggest positioning portfolios in respect to the upcoming election? I know that's something on everyone's mind.
Yeah, this is a great question. And it's going to seem so reductive for me to keep answering this with, well, make sure you have an investment strategy. But that really is the truth. If I were to give you the data from every single presidential election that we have on record with the stock market, I would tell you it doesn't really matter who becomes president. As a long term economist and investor, I would tell you it matters a lot who becomes president. Because the economy, especially the investment world, right, is going to respond more favorably to more freedom, and it's going to respond less favorably to less freedom. Now, this takes the course of many, many years for these things to happen. But in general, what's the answer to that question? It's probably not going to affect your daily investment life if you're choosing an investment strategy and sticking with it, because here is the reality. There is no great way to make long-term wealth unless you are investing in equities. And investing in equities, things like stocks, index funds, right, mutual funds, is simply investing in people. You're placing a bet that humankind is going to continue to improve the world around us. That is the story of investing. That is the most efficient way to create wealth for people, to create jobs, to improve the world around us. That's the basic bet you're making. No matter what strategy you choose, That's why it's so important to have that as the primary component. So I have no idea what's going to happen with the election, where that may take the investment world. But I do know that any one of those four strategies, if you were to choose it, would get you where you needed to go if you were to stick with it. And that, again, is more important than trying to read the tea leaves.
So a quick note to our audience members, I misspoke when I said to put questions in the chat. Please put them in the Q&A, which is a separate button at the bottom of your Zoom screen on the panel. It will say share screen, pause, stop, share screen, and then Q&A. Put them in the Q&A because James has kindly offered to answer everyone's questions after, I guess, even if we run out of time. But I will read from the chat, from the ones that were already inserted there. So the next question is, could you very, very briefly cover the dual momentum investing strategy?
I think the best way to cover that is to say that there's a really good book on it written by Gary Antonashi that you can get on Amazon. You can go to Gary's website. Gary's a Harvard MBA. He was in Wall Street for many, many years. And he combined two concepts that academia discovered. And in fact, every investment strategy I showed you actually comes from academia. Investing is interesting like that. Oftentimes, depending on the field you're in, the academic world could add a lot or may not add a lot. It adds a lot in investing. It's done a lot here. Gary's written really the best work on that subject. In brief, it's based upon human nature. And the idea is this: prices, whether it be the stock market or the clothes that you like to buy or the movies you like to rent, are influenced by how people feel about them. So the higher a stock price goes, the more people prefer that company or that stock. The lower it goes, the opposite. The strategy at its core is following what happens with prices, therefore following what people are doing in the stock market. I can tell you factually that people are, in fact, by far the largest influencer of what happens in the stock market. And that is where that theory begins. And again, really, you can pick that up. You can read that book. That's the best way to go about it. But that's a very broad and general overview. It's an investment strategy based on us.
The next question is, if you wanted to get involved in investing using a professional, how much money do you need to bring to the table in order to make it worth it for that professional's time?
That's a good question. And this one ranges all over the board. So a firm like ours, we started our firm because we wanted to help people. Now, on average, we're generally going to take full-time clients that have more than $1 million. Every firm has a different level, but fiduciary firms tend to do what my firm does. We don't turn anyone away. Anyone that comes to us, regardless of wealth, age, stage, whatever the case may be, we will help them. We'll make sure that they get what they need to get their lives started or going or get out of debt or whatever the case is. There are plenty of fiduciary firms that will do that as well. So I would say to you that not every firm will do what our firm does, but it's really important that you begin to call, ask around. Do you have a minimum? Do you work with clients on a project basis instead of a full-time basis? But again, most importantly, try to find yourself a fiduciary. Try to find somebody who will take care of you, that has a legal obligation to do what is best for you. But the simple answer to your question is it depends, which is the worst of all answers. So call a few people and then see, again, if there are firms out there that will do what ours do, which I know there are really in most cities across the country.
Next question is, how can you catch up with your retirement planning if you've not been able to save much into your 40s? I'm sure much is relative, but I think this is probably a good question for people who don't want to admit they haven't saved as much as they want.
Yeah, and this is a math-based question. I'm going to give everyone a stat that's not so comfortable. So half of you out there that are in your mid 40s to the age of 61, 62, 50% of you do not have enough saved for retirement. But enough actually means nothing. You have nothing saved. And that is not good, right? You can't count on someone else to provide for you in the future. However, there is hope, but this is going to be tough medicine. This is cough syrup that you don't want to taste. It's not going to taste good. You would need to save as much as 30% of your gross income, which means you'd have to get very serious about what you're spending and how you're living and what you're doing if you wanted to be able to provide for your future. Now, that's certainly possible. It's completely doable. We've helped clients do that. But if you have saved nothing into your 40s, the answer is going to be right around 30%. If you've saved something, again, there's a mathematical answer to that. But that's why it's really important to see somebody who can help you figure out exactly how much you need to begin saving. Don't leave it up to chance. There is a mathematical answer to your situation.
The next question is, besides 401k and the normal bank account, what extra account do you recommend and how to, I guess, for how to keep rainy day funds producing interest?
So when it comes to a rainy day fund, I mentioned on the talk that typically you want to keep it in cash. So you could use a savings account at a bank, which is just fine. You could use a CD at a credit union, which is fine, assuming you're able to break that CD and get out of it. Typically, you can without any kind of serious penalty. What matters the most is that you can access that money quickly and efficiently in the event that an emergency happens. Again, as you step your wealth level up, let's say that 20 years down the road, you've got a couple $1,000,000, you're making $300,000 a year. What you do for your emergency fund will change significantly. That goes beyond the scope of today, but in general, your emergency fund should be something that is there, that it's safe, that you're not going to have it fluctuate so that you can use it in the event something unexpected happens. And again, unexpected things happen all the time. As humans, we think that's not going to happen to me. It's not going to happen to us. I can assure you it will. So make sure that you have some money set aside.
The next question is, what are the most important factors to consider as you determine the level of risk you can carry in your investment portfolio?
So the most important factor to consider is not how you feel about it. And that's going to be an answer maybe you haven't heard. Oftentimes we say, well, what's your risk tolerance? And how do you feel about gaining or losing money? That's actually pretty irrelevant. The answer is, how much money do you have? How much money do you need? And what is your expected lifestyle? And again, there's a mathematical answer to that. So let's say that I'm a very frugal person. I save a lot of money. I don't plan on spending a lot of money in retirement. I can take a lot less risk. I don't need as much return. The opposite is also true. If I'm not saving a lot of money and I plan on spending a lot of money, I would have to take a lot more investment risk to be able to provide for my needs. In reality, you want to wind up making sure that you marry both of those together, spend the appropriate amounts, save the appropriate amounts. Then you can wind up going for a moderate, if you will, portfolio that balances your risk and return appropriately. But that answer is always, again, take the minimal amount of risk to get what you need. And again, it doesn't matter how you feel about it. You have to take enough risk to accomplish your goal, or you're going to wind up falling behind. That is why you can't just hold cash, because cash is not going to wind up getting it done.
The next question is, what are the most important factors to consider as you determine the level of risk? Oh, I'm sorry, I just asked that question. The next question. Deja vu, everybody. The next question is, what are your thoughts on leveraging the current low interest rates to consolidate debt through a home refinance? Is this a smart move in today's financial climate?
Again, I feel like a broken record, but this is good because that's a good question and it's one I get all the time. There is a mathematical answer to that, and it's really actually very simple. So take all the debt that you have. Imagine you pay it off over X amount of years, which you can find calculators online to help you with this. You're going to get a total cost. It's going to cost me $100,000 in total 10 years from now to pay off all my debt. What if I instead refinanced all that debt? I paid $4,000 to $5,000 to the bank as a closing cost and got a lower interest rate and paid it off in 10 years, 15 years, whatever. What's the total cost there? If the total cost is lower, do it. It's really that simple. Do it. That's what you should do every single time when it comes to debt. But you have to make sure you factor in the total cost. That is the answer to each and every single thing that you'd be looking at when it comes to debt. If you can lower your interest rate, meaning you can lower your total cost as well, do it. Lastly, as an example of this, there are times when you could lower your interest rate, like refinancing your home, but you actually wind up increasing your total costs, in which case you wouldn't do it. So always make sure the total cost goes down. If that's the case, go ahead and do it.
So the next two questions are actually put us at both ends of the spectrum, someone who is just graduated from college and then someone who is about to enter retirement. So bear with me because I'm going to send you two questions at once. The first one is it generally better to prioritize saving for retirement and investing or paying off student debt once you start earning? And then the second question is, being within 10 years of retirement, when do you suggest that I move my investments to low risk options? I can repeat the question again after you finish answering the first one, but I thought it was interesting to get that perspective, just entering the job market and about to leave it.
No, that's good. I think I'll take them. I'll take them both. Hopefully, here. If I forget, I'll lean on you for the first one, and that's a very common question and a very good one as well. Great questions today, by the way. These are fantastic. What you want to do is you want to do both. So what I will prescribe is to do 10%. Again, if you're making an income, 10% of your income, your gross income, will go towards retirement. Get that money invested, and then I start with 20% or more towards student loan repayment. So that's going to be 30% of your budget, especially if you're coming right out of school, you haven't made an income, you're used to living cheaply. It's a great time to employ this kind of strategy. But 10% of your gross for retirement, 20% or more, depending on your tolerance and what you want, towards paying down your debt is an excellent way to go about it. In general, there are situations when I would not advise that you save for retirement, and that is only when you are in extreme levels of debt relative to your income, and those interest rates are very, very high. And the reason for this is quite simple. Compounding, we want it to work in our favor, and we also want to get rid of the compounding working against us. So it's the seesawing effect. Oftentimes, it's best to obviously put compounding in your favor while also reducing the compounding against you at the same time. So again, try the 10-20 or 10-30 strategy, if you will, where you put 10% to your future and you put 20 to 30% towards paying down debt. That tends to get you out of debt between 4 to 7 years, which is really nice coming out of school. On the other side, if you're 10 years away, when it comes to reducing your risk, I've got a secret for you here. You're not going to reduce your risk. In fact, you probably shouldn't reduce your risk. Here at our firm and most other fiduciary firms, you're going to wind up keeping really the same portfolio that you had when you were working when you're retired. And the reason for this is quite simple. Most Americans are going to live into their mid 80s, some into their mid 90s. When you retire, you're going to have 15 to 20 to 25 years of living remaining. You cannot simply just retire in your 60s and say, great, I've made it. I'm going to put myself into a very conservative portfolio. Again, the answer to the question is you will always take the least amount of risk necessary to get the return that you must have. But for most people, the sound answer to that question actually is not to change the portfolio that you have. You will oftentimes still need that same amount of return to continue in retirement.
So the next question actually puts us smack in the middle of those two people. For someone who is 20 plus years away from that goal of retirement, what's the best way to weather the current financial market or even capitalize on the opportunities presented by a down economy? I know you've talked about the uncertainty ahead, but I thought this was an interesting twist on that.
Yeah, that's a lot of people find themselves in that situation, and the answer to that question is that you have to have an investment strategy because look, I don't know, you don't know, no one knows what the next 20, 25 years will look like. We just don't know. You could wind up having a really difficult 10, 12 years of an investing career, so to speak, within your time frame, or it could be great. We just don't know. We have no idea. So again, you have to have a prudent investment strategy. As you saw on the screen earlier, and as you'll see from the slides, certain investment strategies do a great job of reducing your worst case scenario, which will allow you to tolerate much better what happens when things don't go your way. But if you have 20 years to go, you really have to look at it as though you have 50 years to go based upon your life expectancy. And we know from the chart I showed you earlier that you need to have the majority of your money in stocks. That's the best way to make money, despite the fact that it's the scariest, it's the most misunderstood, it feels like it's this emotional roller coaster. That's just going to be the truth 10 times out of 10. And again, have a strategy, spend your time right now figuring out how you want to invest, who you want to invest with, check those boxes, put your head at the pillow at night knowing I've taken care of what this looks like. Now, my job is to wind up remaining employed, filling those buckets with money, knowing that the rest will take care of itself. That I think is the wisdom, is make sure you address this now, build your foundation, and then do what you can to control what you can control, which really is what kind of income you make and how much you're spending and those sort of things. That's the peaceful way to go about it.
So the headline of the event is to have an investment strategy.
Yes.
That's the big takeaway. But I'd like to know, kind of bouncing off that question, how do you capitalize off of what seems like a bad situation, a bad economy? Like, how does James invest his money right now?
Well, our portfolio at the firm is based upon dual momentum, which you saw, and then it goes beyond that, and we invest in that for our clients and for ourselves, whether it's good, bad, or indifferent. A lot of times people think, hey, the market's down, now is a good time to buy. It's so much cheaper than it's ever going to be. That is actually pretty much always true. In fact, here's a fun stat for you. On average, every 3 to 5 years, the stock market makes a new high. So when people say, wow, the stock market is higher than it's ever been, isn't it overvalued? The answer to the question is, well, that should be expected because on average, every 3 to 5 years, that happens. It's going higher. That's one of the beauties of, again, investing in people is they should be improving the world around them. That should get higher. That should get better. So what is the answer to taking advantage of a down economy? Don't fret about the things that you can't control. Don't spend your time worrying and having anxiety about things you can do nothing about. But keep investing in yourself. Learn more, build your skills, gain expertise, become more employable, right? Do the things that allow you to be more successful. Because the more successful you are, the better you are at something, the more employable you are, the more resources you will have. It's the same for your money. The better you employ your money, the better strategy you put your money into, the better it's going to work for you. And this is true in any environment that you're in. Lastly, for a way overly simplified example, farmers have to plant seeds no matter what the outside environment looks like. Of course, they'll tactically react and change what kind of crop they're growing based upon year to year, but it's never a good idea for a farmer just not to plant in his fields for years and years at a time. Not a good idea. The same is true for your money. You need to be consistently employing your money for you, no matter what the economy looks like or how it feels. You have to wind up continuing on that process.
So I feel like we have perfectly timed this event. We have 3 more questions and about 6 more minutes. So this is wonderful because that never happens. The next question I'm going to ask is, what should I do with the 401k accounts from former employers? Leave them alone or move the money somewhere?
So in general, especially for me, like if you know how you want to invest or you know your strategy, you'd want to move those. And the reason is quite simple. You're going to get more choices to invest in if you move your 401k to your own IRA. For example, you roll it over. There's no tax consequences to do so. There's no downside to that. You're just basically moving your account from a place that is restricted to a place that is not restricted. So you want to move those 401ks, get them out of the old places when you're no longer working there, put them into an IRA and invest them that way because you get more choices, and more choices should lead to better performance, and better performance leads to more money, more wealth.
Great. Next question. Is it true that index funds are the best bet for long-term investing?
It is true that the majority of active investment strategies, so investment strategies that are trying to predict what's going to happen or are trying to guess which way things are going to go, are not going to do well for you. Okay. Index funds are simply just a way to own the stock market. That's really all it is, without guessing who's going to be tomorrow's winner or loser. So it is in fact true that owning an index fund as a base strategy is a great way to go. It is not true that they are always better than some strategies that use active management, but in general, the Warren Buffett strategy, as we showed on my slides, is in fact a good one. Just take all your money, put it into the S&P 500 index fund, put 10% into a bond index fund, and never look at it again. The odds are that does in fact work, and it works pretty well. There are better strategies, but as a starting point, that's an excellent place to begin.
Oh, Sarah, I think you might be on mute for this one.
You're right.
Here we go.
Thank you very much. The last, that's not a good way to end, but this is a good way to end. I have the last submitted question is actually a rather fun one. And it is, what do you recommend to teach high schoolers about stocks and bonds?
So I think the best thing to do is to teach people about the people behind what happens. One of the things I believe in life is we often talk about innovations, inventions, discoveries, but we don't talk about the people. And as people, we're interested in people. That's what motivates us the most. So when you talk about investing, you talk about the story of humans, the story of people improving the world around them, the story of cell phones and automobiles and air conditioning and airplanes, right? These are all people inventing, creating, figuring things out, solving problems around them, whether it's the wheel or geometry, or the written word, right? These were all huge improvements in human history. And all of these led to where we are today, to having the information that we have, to allowing us to create things. When you talk about stocks versus bonds, you start with that story first. Owning a stock or owning an equity or owning something is putting you on the side of investing in people, creating a better world, creating a better future, creating better things. When you wind up using a bond, you're essentially lending your money out and you are not participating in people making the world around you better. Yes, it's much more conservative, but you have no upside. You have no appreciation in human achievement. And that's not to say that bonds don't have a place. They do. In fact, the reason why stocks and bonds work so well in a portfolio together is bonds do wonderfully well when the market's not doing well, right? So there's a reason to own them. But I think as a high schooler, that's a really good way to begin, is demystify this whole idea of a stock and math and a chart and connect it to people. That's really all it is. A stock is a way for us to participate in someone's ideas and someone's creations and someone's creative abilities. And at the end of the day, we're making a bet that people are going to improve the world around us. And that is owning something. And that, I think, is what connects all of us throughout really all of recorded history, is does that keep happening or does it not? And that's the story of stock ownership.
These were great, fantastic, and really insightful answers to really, really poignant and wonderful questions. And so, I just wanted to point out that I thought everyone learned a lot from this, and the questions that were submitted and asked during this session were really show the level of interest in this topic. And I think you really delivered it in a way that really speaks to people on that personal level. So, James, thanks.